What should be considered when investing in stocks? Investing in stocks can be a great way to grow your wealth over time, but it's important to approach it with a well-informed and thoughtful strategy. Here are some key factors to consider when evaluating potential stock investments. The company's financial health. Before investing in a stock, it's important to understand the financial health of the company. This means looking at the company's balance sheet, income statement, and cash flow statement to get a sense of its assets, liabilities, and cash flow. In particular, you should look at the company's revenue, net income, and earnings per share, EPS, to see if it is growing and profitable. Additionally, you should check the company's debt levels to see if it is carrying a significant amount of debt that could be a risk to its future growth. Industry trends. It's also important to understand the industry in which the company operates and how it is expected to perform in the future. You should research the overall size and growth of the industry, as well as any major trends or disruptions that may affect the company's performance. For example, if the company is in the retail industry, you should be aware of the growth of e-commerce and its impact on traditional brick-and-mortar retailers. Management team. The management team plays a critical role in the success of a company, so it's important to research the team's track record of running the business. Look for a management team with a history of making smart strategic decisions and delivering strong financial results. Additionally, you should check for any red flags, such as insider trading or past legal issues. Competitive landscape. Analyzing the company's competition is also important when evaluating a stock investment. Look at the company's market share, product offerings, and pricing compared to its competitors. Additionally, look for any barriers to entry that protect the company's market position. A company with a strong competitive advantage is more likely to be able to sustain its growth and profitability over time. Valuation. When evaluating a stock, it's also important to consider the company's valuation. This means looking at metrics such as the price-to-earnings ratio, PE ratio, price-to-sales ratio, PS ratio, and other valuation metrics to determine if the stock is undervalued or overvalued. A company with a low PE ratio, for example, may be considered undervalued, while a company with a high PE ratio may be considered overvalued. Risk. Lastly, it's important to understand the level of risk associated with the stock and how it fits into your overall investment portfolio. Different stocks carry different levels of risk, and it's important to have a mix of high and low risk investments in your portfolio. Additionally, you should consider the company's business model and its exposure to external risks such as economic downturns, changes in regulations, or other factors that could affect its performance. In conclusion, investing in stocks can be a great way to grow your wealth over time, but it's important to approach it with a well-informed and thoughtful strategy. By considering factors such as the company's financial health, industry trends, management team, competitive landscape, valuation, and risk, you can make more informed investment decisions and increase your chances of success. It's also important to remember to diversify your portfolio and not to invest more than you can afford to lose.